let me pick up from exactly that question of, what I showed you so far was the evidence we had on home currency bias really shaping investor portfolios. And so now what we want to do is basically get into what's the implication of that. So how exactly does this affect the allocation of capital to firms within and across countries? And so the kind of easiest way to get started on seeing this is literally just to say, how does the currency composition of a firm's debt, just knowing how much a firm borrows in foreign currency, how much does that tell you about how much a firm has borrowed from foreign investors? And so if you look in, let's look at the Canada graph again. On the x-axis, I know the labeling is small, this is the share of any firm's debt in foreign currency. Each bubble is a particular firm. The size of the bubble gives you the size of how much they've borrowed. So if a firm is basically at the origin, that's saying that they have none of their debt in foreign currency, 100% of it is in Canadian dollars. The y-axis then just says, well, how much of that firm's debt is actually owned by foreigners? And what you can see is that it's basically a 45-degree line, that knowing how much of a firm's debt is in foreign currency for Canada essentially tells you how much of their financing is coming, at least for bonds, is coming from foreign investors. And you see something very, very similar for the Euro area and Great Britain. Things look a little bit different for the United States. Here, when you see that big cloud in the lower right, the lower right panel for the US, you'll see a bunch of firms that have none of their debt in foreign currency, which means that they have all of their debt in US dollars. Yet you see a big dispersion in how much of their financing comes from foreigners. And so what you can see here is that the US looks a little bit different. Now, even with that said, American firms that borrow more in foreign currency tend to get more of their capital from foreign investors. Now, you might think, okay, this isn't going to matter for which firms, the ability of firms to get foreign financing if we were in a frictionless world and home currency bias was there. So investors all demanded to lend in their own currency. You would imagine, okay, I'm a Canadian firm. I want to borrow from British households. I'm going to issue a bond in British pounds, satisfying the investor's home currency bias, and I'll costlessly hedge that back into Canadian dollars, or I'll bear the currency risk. And if it's frictionless, I'll basically cater to every market, and I can borrow from every type of investor and satisfy their preferences without any distortions. However, when you actually plot, and what this is showing is the number of currencies that a firm borrows in on the x-axis, and every dot here is a different firm. On the y-axis. On the x-axis is the issuer's rank in total borrowing. So the bigger firms are on the left. What you see is that overwhelmingly firms borrow in very few currencies. Mostly they just borrow in one, their own. It's only the largest firms that are actually going to borrow in foreign currency. And because everything we've shown about home currency bias means that if you're not borrowing in an investor's currency, you're not going to be getting capital from them. And so the easiest way to really kind of dig into the implications of this home currency bias, combined with what looks like, these graphs are basically showing something that looks like kind of a fixed cost of issuing that every firm does not borrow in every currencies, is to say, how different does the allocation of capital look when foreign investors lend to firms than when a firm gets domestic investment? And so the key here is going to be basically that foreign investors are going to completely avoid local currency only issuers for Canada. So this is a complicated graph, and so I want to go through very carefully. Please do interrupt if nothing is clear, if something isn't clear. On the x-axis, we sort firms according to the size of their borrowing. So again, on the left, closer to 0 and 1, those are the bigger firms. We've sorted them according to their size in the domestic portfolio. On the y-axis, it's how much of the domestic portfolio in red or the foreign portfolio any given firm accounts for. And so what you can see, the red dots are how much of the domestic portfolio a firm accounts for. The blue diamonds are how much of the bonds issued by the same firm show up in foreign portfolios. On the left, we do this graph for all issuers in Canada. So the top 500 largest Canadian firms that issue bonds. And so, you can see that there's some big differences between the weight in the domestic portfolio and the foreign portfolio. But you can really see the difference between how differently domestic and foreign investors behave is when you look at the right graph, which is we're throwing out from that left panel any firm, any Canadian firm that's issued a bond in a currency other than the Canadian dollars. So this only local currency issuers graph is basically saying, let's only look at the Canadian firms that borrow only in Canadian dollars. And let's ask, how much of the domestic portfolio in red do their bonds account for versus how much of the foreign portfolio do those same firms account for in the blue diamonds? And so what you can see is that some of these firms that are local currency only are pretty big. So the largest local currency only issuer accounts for more than 3% of Canada's domestic bond portfolio, Canadians investing domestically. But when you see all those blue diamonds, the foreign portfolio just at zero, what that means is that all of the Canadian firms that are borrowing only in Canadian dollars are essentially not getting bond finance from foreign investors. And so the firms that are borrowing only in Canadian dollars are essentially only getting domestic bond finance. What we can then do is make that exact same graph, not just for Canada, but also for the Euro area and Great Britain. And going back to the earlier question, remarkably, the Euro area, firms in the Euro area that are issuing in euros, a very liquid, massive market. What you see is that there's a ton of firms that only issue bonds in euros, and they account for a large fraction of Europeans' investment in Europe. However, even for the Euro area, what you see is that the firms that borrow only in euros get very little of their financing from foreign investors. In the lower left, we make the same picture for Great Britain. And again, there are plenty of firms that borrow only in British pounds that account for a large fraction of the UK's investment in itself, but they're nearly absent from foreign portfolios. In the bottom right, you can really see the sense in which the US is different. This is looking only at American firms that borrow only in dollars. And here, you can see that for the American firms that borrow only in dollars, the share of the domestic and foreign portfolio they account for is very, very similar. So whereas the Canadian, European, and British firms that borrow in the local currency are largely excluded from foreign portfolio bond investment, that's simply not the case when it comes to foreign investment in the United States. Now, the way you can kind of see that in kind of a single graph is basically to add up those red dots to say how much of the domestic portfolio do firms that borrow only in the local currency account for, and compare that to the sum of the blue diamonds. How much of the foreign portfolio do those same firms account for? And so on the left, you can see that American firms that borrow only in dollars account for around 60% of the US domestic bond portfolio, but around 50% of the foreign portfolio. That's not, when you look at any other country, local currency only borrowers account for a huge fraction of the domestic portfolio, but foreigners are dramatically underweight these local currency firms. Now, you might say again, well, there could be a compositional difference in the firms that are, there's something else that's explaining, why a firm would borrow in foreign currency. And so the way we want to get at that is to say, well, if there's something different about the local currency only borrowers that makes them less appealing to foreign investors, maybe when we look at, whether domestic or foreigners own, invest in these firms in terms of their equity, maybe we'll see a big difference there. And so here you can think of this as almost a placebo test of, do we see firms that borrow only in the local currency getting a different share of a different weight in the domestic and foreign portfolio? And remarkably, the answer is no. That across countries in the equity, they get the same similar allocation, but when it comes, it's really in bonds, in currency, where we see this big division. Now, So that's kind of this idea that we've shown that international currency, this issuing of the dollar as the global currency is really going to affect the nature of capital allocation. And so in particular, we think this is the kind of a novel benefit of issuing an international currency. You can essentially think it's opening the capital account for local currency only borrowers. American firms, when they want to borrow from foreign investors, they don't have to do anything different. They have to issue a bond in dollars, and that's already tapping international markets. Whereas if you think of what firms in other countries have to do when they want to tap international markets, if they want to cater to foreign investors, they have to change their currency. And because it looks like there's this selection, this size-dependent selection into foreign currency issuance, this is going to change the set of firms that are actually borrowing. So now this raises the question of how much can this international currency use change over time? And so Matteo alluded to this in his introduction when he mentioned kind of the long history of the international monetary system. But one remarkable thing that we document, just looking over this recent period, is the extent to which the cross-border use of currencies has changed just over the last 15 years. And so particular around the global financial crisis and then the European sovereign debt crisis, you see a huge change in the share of cross-border financing for corporate bonds that's in dollars versus euros. And so I think we kind of discussed some reasons why that would be the case, but fundamentally understanding the drivers of this shift is an important research question. Now, one of the benefits of having the kind of underlying data is we can really look at whether this aggregate pattern is driven by kind of compositional shifts that have little to do with currencies. So I'm not going to go into the details, but we can kind of make this exact same graph controlling by entry and exit using fixed effects, as well as taking out any mechanical valuation effects. And what's remarkable is even there, this huge shift of cross-border finance from euros to dollars kind of stays through. And going to the earlier question on whether we see something similar in bank loans, we look at this using microdata from syndicated loan issuance from SEC Platinum. And here we actually can split the type of firm that issues, so manufacturing, finance, investment, real estate, trade, and services. And again, we see a very similar pattern of this rise of the dollar and decline of the euro over the last decade plus. And so I want to end very shortly here to make sure that there's plenty of time for questions, but I do think that there's kind of some big research questions kind of still out there. We showed evidence of this size-dependent friction, something that looks like kind of a fixed cost of borrowing in foreign currency, but what is it? What is actually driving this size-dependent selection of firms into borrowing in foreign currency? What is it that would actually prevent a firm from tapping international capital markets? What's going to determine investor currency preferences? What is it about the dollar that makes it kind of the exception to this investor home currency bias? And then having documented this kind of huge change in the international use of currencies, kind of what are the real effects of this change in international currencies? And so with that, let me stop and make sure we have time for plenty of discussion.